In this third part of this video, we're going to talk about the importance of financial statement analysis. So what really financial statement provide and what kind of information they provide to the users to understand. A lot important relationship among financial statement, line items, and changes in them for a company over time. This assume an auditor observed that account receivable is increasing as a percentage of total asset. She may seek additional information such as whether sales are also increasing, collections are decreasing, or the firm has relaxed credit extension practices. So for example, usually what happens when people try or business trying to lie about their revenues on their financial statement, they simply do this: debit account receivable for say 100K and credit revenue for 100K. That increases their account receivable as well as increases their revenue. So if this is the case, then we will have to get more information. How we get the more information? Well, when I have an account receivable, that means I have provided some customer a service or a product. So how this process begin? So in big businesses, what happened, a customer will send a request, just like a request you send it to Amazon. Hey, I would like to purchase. That creates a purchase order. So the purchase order, so for example, in your house, if you are a business and you want to purchase something, you create a purchase order. That purchase order will be approved by your parents, for example. So then it will go to the business you purchasing from, say Amazon. Amazon will check your credit worthiness. If you are good, then they will offer you a credit. And then once they offer you a credit, then this information, once your credit approved, it went to the accounts, the warehouse that sent this customer. At every step, it generates some paper. And all of those papers goes to the account receivable department that sends you an invoice that you owe us this much money. So if you want to check whether the company or a business is lying about this kind of thing, you can go back and ask, okay, for this $100,000, I want to get all the paperwork from your approval department, customer request, which is a purchase order, and the shipping papers that you got from the warehouse, and the invoice that you send to the customer. Another thing, if the percentage of cost of goods sold to sale has increased, the company's manager would seek to determine the reason. Higher cost of sales percentages could be due to higher raw material cost. So for example, you were selling a cake for $100. The cost of goods sold or cost of cake was $50 for the first year. The second year, that cost is now $60. So you want to know why, what happened, that you are still selling the cake for $100. Last year it's costing you $50. This year it's costing you $60. You can say, hey, the government may have increased, for example, minimum wage. The milk and milk products has become expensive, or I am paying electricity cost has increased, or I have include. So you must have a reason to find out if a cost is going down or cost is going up. If the company is consider a bank reviewing a credit line application for a company, just like you apply for a credit to a bank either to purchase a home or purchase a car, and they review your credit worthiness. The same thing when a customer asks a credit line or want to purchase something on a credit from another business, they evaluate your credit worthiness. If you are credit worthy, they will let you have things on credit, means you can pay later. If the company existing debt is high or its cash flows are decreasing, the bank would be concerned about the company's ability to repay the loan. So what happened when a bank gives you the cash to invest in your business? They are expecting that you should be utilize all the cash in in your business, and you will make enough money to pay their interest expense every month, every quarter, or every year. If your business is unable to generate enough cash to pay for rent, utilities, employees, payroll, and banks, so the bank become concerned because the company's ability to repay its obligation reflects that the business is doing well. So these are the things that we like to analyze financial statement to check for those things. Then we're going to talk about, we do two kinds of analysis, horizontal and vertical analysis. Reporting results of operations, which is, in income statement, financial position, balance sheet, and a statement of cash flow for more than in comparative financial statement. That's what we do. Companies issue comparative financial statement to provide financial information for more than one reporting period. So sometimes companies provide you one income statement and two balance sheet for this year and balance sheet for previous year. Sometimes they provide you three balance sheets, 1 year, previous year, and a year before previous, and two income statement, this year income statement and the last year income statement, so the readers of the financial statement can compare the performance for 2 to 3 years. Common size financial statement measure each financial statement line item relative to some key amount or total. So in income statement, the sales become the 100% and net income is become maybe 10 or 15% of the sale. So what we are saying that, for example, your sales is 100%, your cost of goods sold maybe 40%, so your gross profit is 60%, your operating expenses are say 30%, so your operating income becomes 30%, and then you pay tax 10%, so your net income is become 20%. So what we are saying that every dollar that comes under sales, 20 cents are going towards the profit, 10% going to the tax, 30% are going to the operating expense such as salaries, rent, utilities, depreciation expense, and 40% are going to make that product or provide that service. And the same thing applies for the balance sheet. For example, you have total assets is 100%, and what percentage is the cash, what percentage is the current asset, and what percentage is the for the long-term assets. Okay. Horizontal analysis examines the percentage change in financial statement item from year to year. The next thing we're going to talk about is vertical analysis. Expresses financial information in relation to some relevant total or amount within the year. On the income statement, each income statement line item is expressed as the proportions of sales that we talk about. On the balance sheet, each item expressed as a percentage of total assets. Ratios compute meaningful relation between financial statement. Ratios analysis can be used to understand the company over time, compare one company to another. For example, we can compare Walmart to Target and benchmark a company. What is a benchmark? So for example, you are in the retail business. In the retail business, Amazon is also in the retail business, Target is in the retail business, Walmart is a business in a retail business. So you just pick one company in the retail which is very similar to the company you are trying to analyze, and you make it as a benchmark, and you compare the business that you are analyzing, its performance with your benchmark. For example, if I'm trying to compare myself with say someone who is a professor in accounting, and I want to know how well I am doing compared to that person. Profitability. Profitability is a company's ability to generate return for its shareholders. We're talking about generating net income. Allows user to assess how well a company has performed and how much return it has generated. We are talking about profit. We're talking about earnings per share that we have discussed earlier. Three common things: profit margin, return on assets, and return on equity. What is a profit margin? The profit margin is basically net income over sales revenue. So what percentages of sales revenue is going into the net income? So if you are making $1 in the sales revenue, are you getting 10%, 20%, 15%, or 10 cents, 15 cents, and 20 cents? A higher profit margin indicates a higher return to shareholders. Return on assets is average total assets beginning. So this is from January 1. This is from December 31st. You take the two assets total, and this gives you the total assets. And return on asset, you take the net income and you divide this average total asset. That gives you the return on asset. So for example, why we are checking? So we are, in every business, we employ a lot of assets. So those assets cost money. So as an investor, you have an opportunity to either invest in this business or you may invest somewhere else, because in the United States, we have lots of opportunities for our investment. So we would like to invest somewhere where our money is safe and we are getting a good return. So it depends on person investor to investor. Some investor may be happy with 5% return on asset. Some investor may want 10% or 15%. So higher the return they want, the higher the risk they have to take. Return on equity is the same thing. Return on the net income divided by average shareholders equity. And the average shareholder equity is the same thing. The beginning balance of stockholders equity on January 1st plus the ending stockholder equity on December 31st divided by the 2. And that will give you the return on equity. So these are the three methods that we use to basically evaluate the performance of a company. The various return ratios addresses the question how well a company is using its resources. Means how well as a student you are using your time, how well you are using the money that you're making. I understand as a student, full-time student, you're not making a whole lot of money, but even suppose you're making $500 a week, how well you are utilizing that $500 a week. In contrast, return on asset ratio, the return on equity is an indicator of company's return to stockholders equity. Return on assets and return on equity tells how well the investor's investment is doing. So this is the end of chapter number 3. We're going to stop here and I will post these videos as soon as possible.